All right, well, let's transition here into an actual case study here. We're going to call this Sarah, or this client Sarah. We're going to put a pseudonym on her. This is a real life 8-figure exit. And she, as part of this exit plan, wanted to really have the next season of life be all about running an operating foundation. So again, what we did here is, as part of the deal, and this was a sale to private equity for $30 million, as part of that transaction and sale, she has an S corporation. But when you are generally selling to private equity, they're going to do something called an F reorganization that essentially allows you to set up a new entity and you contribute your S corp stock for essentially stock, and then you drop it into this subsidiary single member LLC underneath it. And it's a tax-free reorganization, because then the buyer of the business wants to buy the company, take the EIN, but they don't want any of the contingent liabilities that come with it. And they generally want to do an asset sale or an asset purchase generally, just because that'll help them with their allocation of basis. So as part of this F reorganization, which the private equity company wanted to do, it was really important that as an entrepreneur, you understand that you can't contribute your S corp stock to a foundation, or else you're going to trigger what's called unrelated business taxable income, which essentially is just UBTI, which just means that even if I ideally want to give stock in my S corp to a foundation ahead of a sale, because then that means I don't have to pay the taxes on it, well, then the foundation has to pay taxes on it if it's an S corp. But by doing this F reorganization, it was technically a single member LLC that was given a portion of that. So $5 million of value in this single member LLC that was created as part of this F reorganization was contributed to this new operating foundation that she created. So then what happens is, when the $30 million came in, 5 of that $30 million is now owned by this other entity. And again, that $5 million is owned by the foundation. So $5 million of cash goes into the foundation, $25 million of cash goes into the entrepreneur. She doesn't have to pay capital gain taxes on that $5 million that goes to the foundation. So that is the workaround to avoid the UBTI. So a little complicated, a little bit of technical jargon. I know
definitely.
We'll see who stuck with us on that. But at the end of the day, I think with the proper structuring, with an M&A team and a tax and legal team, there's ways that you can do this in a tax-favored
You would not want to do that on your own, for sure.
So the result here, again, is $5 million now is seeded into this private operating foundation. Now, she, again, is involved in the day-to-day operations. And so we took that $5 million and invested it all in like high yield or high income investments. And then we just need to make sure that over 85% of the income or the yield is then used on operations. But she didn't want to have to keep putting more money in. So that $5 million seed amount, then multiplied by, let's say, a blended average yield of 9%, creates a $450,000 a year operating budget that she is then using in her operating foundation. So that was the methodology there. She is soliciting contributions from third parties, friends, family, etc., but she's got enough money getting generated passively, and that money is, again, appropriately being spent down to just fund the day-to-day operations and active operations. So that way, that's how we pass all these different tests.
Yeah, and if you think about it, this was something that really made a difference in her life. Like, this was a mission that she wanted to achieve and accomplish, and she was able to do that and still have a majority of the money for herself for the way she wants to live her life.
Yep.